So my name's Shiloh Bates, if we haven't met before. I'm here to talk about CLOs, and I've spent almost my entire career in the CLO market. I spent the first 10 years investing in the kind of leverage loans that go into CLOs, and then the last 10 years investing in CLO securities directly. So I'm the CIO of Flat Global. We manage almost $1 billion of AUM, and a lot of that is in CLO equity and CLO BBs. One of the things we try to do at Flat Rock, besides doing a good job managing money, is just having a really thorough educational process for our investors and potential investors. And so as part of that, last year I wrote a book on CLO investing. It's available on Amazon. We also published a CLO equity index, which goes back to 2014, that has a lot of valuable information in it. And then just as a firm, anytime there's something interesting happening in the CLO market, we try to put out a white paper and educate folks. So that's why I'm here today to talk about CLOs. So even if you're not invested in CLOs now or thinking about it, I think there's a few reasons that you should know about CLOs. So one is that it's a $1 trillion AUM market. And so it's the same size roughly as the leveraged loan market. The high yield bond market's also about $1 trillion, and private credit as an asset class is about $1.4 trillion. So it's a very big market, and CLOs sell securities initially rated AAA at the top part of the capital stack and down to BB if you're investing in CLOs debt. And then we also invest in CLO equity, and so there's investment opportunities for people who are seeking very secure and stable returns. In the top part of the capital structure, those are rated AAA. And then for people seeking higher returns and who are willing to take higher risk, BB and equity can be interesting. In CLOs, basically all of our markets floating rate. So since 2022, we've really benefited, and higher for longer has been our friend. And CLOs are a little bit complicated, but I like to say they're complicated in a fun way. You guys can let me know after what you think. So the important thing to know about CLOs is that they're not the CDOs that were the focus of The Big Short by Michael Lewis. So I enjoyed the movie. I read the book a few times. But the CDOs that he is talking about had as their collateral subprime mortgages, really of dubious credit quality. And what you find in CLOs, on the other hand, are senior secured corporate loans. They're to borrowers that are owned by a private equity firm. So there's some vetting there in terms of the quality of the loan that goes in. CLOs are very transparent. For all of our CLOs, we get a monthly trustee report, and it has pretty much all the information that we would want to know about the loans. Whereas for CDOs, reporting just really didn't link to the underlying assets. For CLOs, at Flat Rock, we're not a CLO manager. So we invest in CLO securities, but there's a CLO manager who's actually picking the loans that go into CLOs. And a lot of the biggest CLO managers are also the biggest private equity publicly traded firms, and they do a really good job with the loan assets. And then correlation is kind of key. So securitization is a very powerful tool, in my opinion. But the assets need to be high quality, and they need to be not all correlated with each other. So in CLOs, you're going to find lots of different corporate borrowers, diversity by borrower, but also diversity by industry group. Whereas in CDOs, it was really just highly correlated. Everything was highly correlated to the housing prices. If you invested in CLOs, even before the financial downturn in 2008, On a buy and hold basis, you did well as an investor in the equity tranche. In CDOs, in contrast, we saw defaults all the way up to the AAA part of the stack. And so the point here is that CLOs are very different from CDOs, and kind of a sub-point to that would be, I think one of the reasons that we're able to extract favorable risk-adjusted returns is that my market is still a little bit painted with this brush of the CDO, and as a result, we're able to get, I think, some pretty attractive risk-adjusted returns. So CLO issuance has been on an upswing. I mean, when I started my career, it was 2000, really on the buy side, so not even on the chart. And the reason that CLOs continue to be created today is the favorable performance of CLOs over really a 30-year track record. And it's investors seeking exposure to actively managed pools of senior secured loans. I think those are some of the biggest drivers. But then on top of that, again, CLO securities are floating rate. So again, benefiting from the Federal Reserve interest rate hikes. So the best way to think about a CLO is that it's a simplified bank. So if you buy a share of JP Morgan stock or BAML stock, Bank of America stock today, those businesses are in 30 different business lines. They're constantly getting sued for their misdeeds of the past. Well, in CLOs, it's really just a pure play lender. So the assets are, in this case, $500 million of first lien senior secured loans. The loans really are secured by all the assets of the company. And these loans are created in leverage buyouts. So imagine Apollo, Ares, KKR. They've identified a company that they want to take private. In the LBO, they might put up 50% of the purchase price in equity. The remainder might come from a first lien loan, and that loan would be sprinkled into literally hundreds of CLOs like this one. So those are the assets, and then it's financed with investment grade debt, which is rated AAA to BBB. That's sold to insurance companies and banks around the world. We don't really, I don't invest there, at my firm, but we focus on the BB note and the first loss equity. So let me explain to you how these kind of work. So first, if you're an investor in CLO equity, you're in the first loss position. So anytime a loan defaults, that's the risk that you're taking. And so I don't know, why would anybody want to do that? Well, the reason is that the CLO is very profitable. So the CLO's assets have a much higher interest rate associated with them than the CLO's financing cost. And as a result, each quarter, the CLO distributes to the equity investor all the profits, and those distributions are in the high teens area. So a lot of cash is distributed to the first loss equity. And then in terms of the risk you're taking on the underlying loans, fortunately, it's not like some unknowable risk. So there's 30 years, again, of data on the first lien loans. And in a typical year, we think loans default at about a 2% annual rate. Usually the recoveries are pretty high too. And so you kind of look back at the last 30 years and say, okay, hey, what are these loans? What kind of happens in terms of loan losses? And then what you do is you factor that in to your profitability expectation when you're in the first loss equity. So when you buy equity, you don't assume that no loans will default. That would not make any sense. There's 200 different loans in the CLO. They do default rarely, but there's always some kind of like cats and dogs where there are issues. So you kind of budget in the historical losses. And at the end of the day, after budgeting in those historical losses, you're still targeting returns in the mid to high teens. So that's CLO equity in a nutshell, and we have a large fund that focuses on that strategy. And then for the double B note, it's different. So the double B is the junior most debt tranche. As a double B note investor, you're secured by all the assets on the left-hand side of the diagram. You don't take any losses on your double B notes unless the entirety of the equity is wiped, which would be a very uncommon thing to happen, and I'll talk more about that. But the double B note is floating rate. It starts at the beginning of the CLO and goes the full life of the CLO, just getting its contractual interest and principal payments. And so for a CLO equity investor, you're targeting higher returns, you're willing to take higher risk. For the double B note investor, it's more of a safe and secure investment, but still pays returns in the low teens area. So I mentioned that BlackRock is not a CLO manager. Some of the biggest CLO managers out there are going to be, are the names here. So Palmer Square, Nuveen, Apollo, Elmwood, Bain. We pay managers like this about 40 basis points to pick the initial loans that go into the CLO and to keep the CLO fully invested during the reinvestment period. And part of my job is both identifying good CLOs specifically to invest in, but also partnering with the best CLO managers. So for example, if you're an equity investor, you're taking the first loss on the loans, and so you're looking to hire a CLO manager who has the best track record in terms of the performance of the underlying loans. So the loans that go into a CLO have what we consider to be a pretty conservative initial loan to value. So here it's 50%. And so there's a lot of junior debt and equity that supports these businesses. And so the punchline is that when you make one of these loans, as long as the enterprise value of the business doesn't decline by half, you should be money good at the end of the day. And keep in mind that most of these companies, they're owned by private equity firms. So it's not just a random assortment of borrowers in there. It's actually a highly diligenced and selected pool where smart guys are kind of the owners of these businesses. And so occasionally these loans will default. It could be because of a regulatory change or a technological change or a loss of like a major customer. But at the end of the day, you do have a lot of junior debt and equity that supports you. And the result is, these are some of the U.S. holdings that you'd find in a CLO. So private companies, owned by private equity firms. Some of these loans, and again, there might be 200 in a typical CLO. Some of these are familiar to me. So Shurion, for example, they do all the insurance contracts for the iPhone or Samsung phones. Cablevision used to be my cable provider in New York, and Virgin Media. You could probably find some other names in the CLO that might be familiar to you. These are all companies that are on average rated like single B. So you're not going to find the largest investment grade companies in a CLO, and you're not going to find a lot of the companies that are making kind of the headlines in the Wall Street Journal are just not going to be the kind of loans you find in a CLO. So when the loans default, historically the recoveries are quite high. And so when you're the first lien lender, you're first in line for any recovery in a bankruptcy. So the high yield bond is usually unsecured. It's just a promise to pay. And there's no real recovery for the high yield bond unless the first lien loan is made whole. And for second lien loans, similar. There's no recovery for the second lien unless the first lien is made whole. So in our business, at BlackRock, I think we're pretty smart guys. But at the end of the day, The loans really just default rarely, and when they do default, you get a high recovery. So I feel like that's a really nice, I feel like we're playing with a pretty high kind of net underneath us, if you will. So the CLO has a life cycle that can go years. And before the CLO starts its life, usually loans are kind of acquired in a warehouse prior to the formation of the CLO. And then the CLO is brought to life when equity investors like Flatrock and others sign up to be part of the CLO, and then the AAA and other parts of the debt come together. Once the CLO closes, you start getting your distributions really within the first 6 months, and they come quarterly after that. And so in CLO equity, for example, the returns that you're targeting, I mentioned it's kind of like mid to high teens. Those are returns that come to you via cash flow. So if you invest in the stock market, you might get a low dividend and hope for capital appreciation. In my market, it's actually the opposite. There's no real capital appreciation, but you're just getting very large distributions that come quarterly. And then at the 2-year mark, the non-call period of the CLO ends, and after that, you may want to go back into the market and try to refinance your CLO's debt at lower costs. We like to do that. But the CLO's reinvestment period runs 5 years. So during that time, the CLO manager might be trading loans, buying one and replacing it or selling another, or just the loans are prepaying at par, and then the CLO manager goes out and buys new loans with the proceeds. And so during that 5-year reinvestment period, the CLO is full, and then when the reinvestment period ends, as the loans prepay at par, slowly the CLO deleverages, and then at some point the equity investors will decide it's time to call the deal, which is really a liquidation of the CLO. For our CLOs, we try to keep them outstanding as long as possible. We like to, once we get through the reinvestment period, to take the collateral and use it really to form a new CLO. We find that to be the most accretive thing we can do for CLO equity returns. So if you're an investor in CLO BBs, just to kind of contrast the two asset classes again, you're benefiting from the equity. The equity is taking the first loss. In the BB, you get your cash flow, your spread over a fixed rate. A fixed rate spread over the base rate. So the base rate for my market is SOFR, Secured Overnight Funding Rate. And so every time, as the Fed's been hiking, that translates into a higher SOFR rate pretty much, within a few days. If you're an investor in BBs, you're targeting lower risk, but you're accepting lower expected returns. And then in the BB, you're really just along for the ride, so you don't get to dictate how long the CLO is outstanding. That's something that the equity has the right to do. And then CLO BBs are they're more liquid in the secondary market. And the reason is that for the most part, CLO BBs are just money good at the end of the day. So because you're expecting to get back par, we can kind of debate whether or not a CLO BB should be worth 98 or 99. But we probably agree that you're going to get back par at the end of the day. And then for CLO equity, it's not that. So you care every loan that defaults affects your return. And so it's the distribution of outcomes is wider, and the result is, people tend not to agree as easily on price, and that means less secondary activity. So people like CLO equity because, again, it's an actively managed exposure to first lien loans. The distributions, come to you right away in the first quarter. And the CLO equity has a low correlation to the stock market and to high yield bonds. And so the result is that, for somebody, trying to manage a portfolio of assets for clients, we think that you can increase the client's expected return and lower the overall risk by putting in CLO equity. And then in each CLO equity piece, I mentioned this, but I think it's kind of worth stressing. There is a loan loss reserve in every CLO equity investment we make. So we buy a CLO equity piece, we talk about the returns we think we're going to make. Embedded in that is the 2% default rate that I mentioned before, the historical 2% default rate. And so the returns we're targeting are net of those loan losses, and that's very different. Like if you invest in a loan fund directly, most people look at the distribution they get from that as the return or the expected return. Well, that's not exactly accurate, right? I mean, as long as every loan repays at par, then that is true. But if you have 200 different loans, again, in my business, the loans are single B on average. They do occasionally default. And it's the same thing for BDCs, by the way. Like if you're an investor in BDCs and a loan defaults, you take a little hit on your NAV, but there's no loan loss reserve. I'm pretty sure about that. One of the things that is also interesting and very favorable about CLOs is what we call the self-healing mechanism, and I'll get to that in ahead here. But in markets where loans trade down in price, usually CLOs are able to take advantage of that. And then overall, like each CLO equity tranche that we're investing in might be 50 million in size, and so it's a very inefficient market. And we found that if you've been doing this for a while, there's really the ability to outperform peers over time. So one of the ways we look at CLO equity returns is just, what's the probability that you have a negative IRR? And so, starting in 2002 through 2019, and we don't have more recent than that because these are for CLOs that kind of went their lives and ended. So more recent CLOs are kind of out in the market, still doing their thing. But it's 6.4% have had negative IRRs. If you look into that, the negative IRR pool, what you find is IRRs that are kind of mildly negative, -5 or maybe -10. But no total wipes, and the reason is a few things. So one, it's the quality of the loans, senior secured loans that go into the CLOs, the quality of the manager that does the picking and the loan selection, and then also because CLO equity returns come to you as distributions that happen really right when the CLO begins its life. Each year you're just de-risking yourself. So if I bought a CLO equity piece today, over the next year, I might expect to get back 20% of my investment just in the first year. Okay, and so then the next year it might be around 20 again. And so with each quarterly distribution that I get, the probability that we end up with a negative IRR is lower. So the CLO self-healing mechanism, this is kind of I think the most interesting thing about CLOs. So how it works is that in pretty much any market, loans are prepaying at par, and the collateral manager is going out into the market and they're buying new loans with the proceeds. And so in a market where loans trade down, and this is what we saw in 2022 and 2023, the loan index is in orange. Well, usually when we buy a CLO, we're assuming that as loans prepay at par, the CLO manager is going to buy a new loan at 99. That's where loans usually are issued. Well, in a market where the potential for recession is up, the loan index trades down. And so during this time, for example, loans were prepaying at par, and the collateral manager was buying new loans at discounts to the 99. And so it's not a huge discount. The loan index was at an average of 95 over the last, for 2022 and 23. But that gives the CLO the opportunity to buy discounted loans that we think ultimately repay at par. And if you're in economic conditions where you think the loan losses are going to pick up, for you that's negative as a CLO equity investor. But if you can buy discounted loans, I think that's like a pretty interesting offset. So CLO equity returns have been quite good over time. And so one of the vintages that we highlight here is the 2007 vintage. And just kind of like walk you through how that worked and why something that had formed right before the GFC had such favorable returns. So if you would have bought a CLO equity piece in 2007, you probably would have been targeting a 14 or 15% IRR. Embedded in that would have been a 2% default rate assumption, and then you would have found yourself in 2008. Well, the default rate peaked at 8% for the loan market. So, 4x, you're seeing defaults 4x what you kind of expected in 2007. So obviously that's quite negative for CLO equity returns. But what happens is the CLO has a very long life, and during the GFC and beyond, loans just start prepaying at par. And fortunately, lots of loans prepay in a year, and very few loans default. And the result is every time a par loan, you get those proceeds, those were invested back into new loans at substantial discounts. And so what the punchline for the 2007 vintage was that experienced more losses than you would have expected initially. That was negative. But at the same time was able to buy discounted loans in a way that the discounted loans actually were more favorable for returns than the negative effect of loan losses. So it netted to be in a good place. And then since then, we haven't seen a default peak like we experienced during the GFC, and we haven't seen the kind of self-healing mechanism working to that extent either. But that's, I think, a very interesting vintage. So this is the simplified CLO model, and I'm just gonna hit it pretty quick. But basically, the loans in the CLO, when SOFR is 5.5, they might be paying a spread of 3.5% over the SOFR rate. The cost of debt in the CLO is floating. It's floating based on SOFR as well. We pay a CLO manager around 40 basis points to pick the loans. And then, we assume a 2% default rate, and when the loans default, we generally assume a 30% loss given default. So the punchline here is that if you invest in loans directly, without the CLO structure, we expect that return to be 8%. So that's the second to the lowest number there. And then when you add in the fact that the CLO has employed this leverage, here we're talking about a net return close to 15%. And again, this has a loan loss reserve built into it, whereas other similar debt investments would not.
Shiloh, do you mind talking about just the structural leverage that's embedded in the CLO versus like what comes to mind when most people think about leverage?
Absolutely. So let me come up here and we'll look at the CLO structure again. So in this example, so the first loss equity is about 10% of the capital stack. So it's levered basically the same as like a US bank today. So it's the 10 times levered. And the CLO AAA that finances a lot of the CLO's assets, that makes up about 65% of the CLO. And the reason that you can get that kind of leverage, all the way through AAA and have it rated as such by Moody's and S&P, is that it's the quality of the underlying loans on the left-hand side of the balance sheet. At Flat Rock, we also invest in middle market CLOs, which have a little bit of a different structure. They're levered 8 times instead of 10. But this is kind of the more common setup here. And then when people talk about leverage in the system, I mean, there's two forms of leverage, right? So it's, I was talking about the leverage at the CLO level, but each borrower is levered, right? So the borrower starts its life with a 50% loan to value. And so as an investor in these loans, like, we don't take any losses on the loans unless really the equity in the business gets wiped. Sure.
With the leverage component that's part of that return stack, with you're in such a long period of reserve monetary policy, with interest rates now more normalized, how does that impact the cost of leverage and the return potential of the CLO market?
Sure. So, and I'll come back up to my diagram here. So a few things going on here. So one is that all the CLOs assets on the left-hand side of the diagram, they're all floating rates. So they're all floating based on SOFR. And so then if you're invested in the investment grade debt or the BB, these are floating based on SOFR as well. So it's really just a pass-through. So if you're an investor in BBs today, you're certainly benefiting from the fact, higher for longer has certainly benefited you. I think the other part of the question maybe is, if I understood it correctly, is that, the borrowers on the left-hand side of the balance sheet, higher interest rates are great to the extent the borrower can make the interest payments, and that's it. And if they can't, then obviously, so it's not good for you. And so how we think about that is we look at the borrower's, the annual cash flow the borrower produces, so that's its EBITDA, and we compare that to its annual interest expense. And so when we left 2021, interest coverage was around 4.5 to 5 times. Now it's about in kind of the low 2s, so 2.2, area or thereabouts. So the interest coverage ratio has come way down, but it's really normalized to a level that'd be more consistent with the last 30 years. So when I started my career in investment banking, I was doing leverage buyouts at Wells, and we were targeting roughly a 2 times interest coverage ratio on new deals. And this is at the end of the 90s, a long time ago. But the reality is, so for the borrowers, the interest expense is up. I want to be here. But the reality is that the amount of junior debt and equity supporting these businesses is sufficient such that we don't see any issues with them making their scheduled interest and principal payments. And if they don't make their interest and principal payments, then the lenders take the keys and work for the best recovery they can find. So one of the resources that you can find on our website is we have a CLO equity index. And so, and by the way, there's indices that you can find on Bloomberg for AAA down to BB, and they're daily indices. So you can get the average daily price of a AAA. I can show you how to find that if you're interested. But CLO equity trades rarely, and so what we've done to create an index that goes back to 2014 is we look at all the investors who are public filers of CLO equity in the market. So for example, our funds are all SEC filers. So every quarter we tell you this is how much CLO equity, these are the CLO equity positions we own, this is where they're marked. And so we look at our data and then our competitors' data going back to 2014. and we use that to create this index. And we think it can be a tool, for somebody who's looking to potentially allocate to the asset class. It's the only index. So we think it could be an interesting tool for folks. Transitioning a little bit to double Bs. So if you're an investor, again, in the double B security here, the key for you is just, what percent of the loans on the left-hand side of the balance sheet would have to default, such that you eat through all the green, all the equity, and you take a loss at your double B. And so we use software called Intex that helps us model that. But basically, what we show in orange is the default rate in the market since the GFC. So that's an orange. And this is JP Morgan data. But it shows that the default rate for loans peaked at 8% during the GFC. And then was also elevated during the COVID period at about 5%. Well, there's two types of double Bs in the market that are common. One is the broadly syndicated CLO double B. If you're an investor in one of these securities, the loans, by our modeling, could default at about a 7% rate each year. And that would result in you missing $1 of interest or principal. It's not a negative IRR or anything like that. It's just you didn't get everything that was promised to you. And so basically what this says for the green broadly syndicated double B is that you basically need the GFC to happen, but instead of it happening for a year and a half, it would need to happen for the full 8-year life of the CLO. So we think that's very unrealistic. And then we're a big investor in middle market double Bs. Those have more equity in them initially, and the result is that basically the middle market double Bs that we're buying could survive almost 2x the GFC, but the GFC would have to, the downturn would have to go on 8 or 9 years. So the result is that the credit quality of these double B investments is very high. And part of what benefits the double B is that you do have the initial equity that's taking losses on loans. But if you find yourself as a double B investor in a position where you've seen an uptick in loan defaults or downgraded loans, what happens is that instead of the CLO making the equity distributions, that cash is retained in the CLO, and it's used to either buy more loans or to delever the CLO. And both of those are credit positive for the double B. We don't have any CLOs that are doing this at the moment because the underlying loans are performing well, but this is kind of a safety mechanism in a downside case. So if you invest in double Bs, historically the default rate's been about 25 basis points over 30 years. So we think, and for leveraged loans it's 2.9%, and for high yield bonds it's 3%. And so, you can hire a good CLO manager, and they can make a loan to a good company, but there's always each company has some idiosyncratic risk to it. And a well-regarded company today, might not be well-regarded tomorrow. And so that can happen for single issuers in high yield and leveraged loans. But in double Bs, it's very different. In double Bs, the setup is you just need one very low probability event after another to kind of eat through all the equity capital. And the result is this low default rate. So again, maybe one of the takeaways I'd like to leave you with is that if you're buying a pool of leveraged loans outside of the CLO structure, it's very unlikely that it's going to be a zero loss loan pool. That's just life. But if you're buying a double B, you're getting exposure to all the same loans in a CLO. But the punchline is somebody else has signed up to take the credit risk on the loans. That's the CLO equity investor. And if you're investing in double Bs, if you talk to a CLO investor like myself, and he tells you, yeah, I'm investing in double Bs, and you should expect a 3% default rate on the double Bs, well, that would be way out of context. That's not what we're doing. We're targeting something more like a 0 default rate on BBs. So a few of the lessons that we've learned over time is just that, and we've been really one of the biggest buyers in the space for the last 10 years. There is really kind of unique CLO expertise required. For us, that's both understanding the CLO structure, but also being experts in the underlying loans that go into CLOs. We've also benefited from having a broad mandate. So, we invest in CLO equity, we invest in CLO BBs, we do middle market CLOs, we do broadly syndicated CLOs. Sometimes we invest in CLO warehouses, which are used to acquire loans prior to the formation of the CLO. And at different times, we just see different value in those different securities. In my market, the most common way that people get exposure to CLO equity is they go to one of the CLO managers and say, hey, I really like you. I'm going to sign up and do your GPLP fund. And, I'll be the equity in your next 4 deals or whatever it is. And we think that's not a great way to do it. I mean, for one thing, there's 100 different CLO managers. It'd be very hard to just pick one. But like we at Flat we're investing in an Ares CLO and an Apollo, and sometimes we're doing new issue, sometimes we're doing secondary. We think that's the way to do it. If you're just going to one CLO manager, what you're going to get is 4 or 5 CLOs that are very highly correlated in terms of their performance. May work out great at the end of the day, but it would be like in equities if you went, somebody said, hey, give me some money and I'll do the next 5 Jefferies Tech IPOs. I mean, I don't know, it could work. We're an investor in CLO BBs. The point here is that even when loans trade down, we still think BBs are very robust. And one of the unique things about Flat Rock is we do like middle market CLOs, which is kind of like a little niche of ours, but the CLO market in general is about 90% broadly syndicated loan CLOs, and we have a niche in the 10% that are middle market. And then if you'd like to know more, so I did write a book on CLO investing. It's on Amazon, and it's written in a way where if you just have some basic financial understanding, it takes you all the way through the CLO story. And then we're also, happy to chat really anytime. Any questions? Please.
When you had that slide up on the projected returns, building up like on your model or whatnot.
Sure.
That was on CLO equity?
This is for CLO equity.
Okay.
So if you buy a CLO BB, for example, say you buy a middle market one, the return that you get over time is just every quarter you get the 3-month SOFR rate, which today is about 5.3%. And then you get a spread over that, which is, we're targeting around 8%. So that's just the current income you get along the way. And it only varies due to the changes in the SOFR rate.
So in that projection, you use a default rate of less than 1, almost 0.
So if you're an investor in equity, we will put the 2% default rate in there because some loans are going to default, and it's going to be our problem in the equity. In the BBs, it's a different analysis. It's this analysis here, and it's not. If you run a 2% default rate through a BB, nothing happens, and you run a 4%, nothing happens. So you care on like the upper limit of how bad defaults could get, such that you're not money good, and that's what this is. So this says, again, for the green, the BSL BB, which is the weaker in credit quality, basically need the GFC level of defaults, and you need the GFC to run 8 or 9 years. And that's why showing you how robust these things are here kind of ties, I think it ties to the historical kind of 30-year outcome. Sure.
Are these standardized in the sense, like, does the broadly
Yeah, good question. So for the diagram that we have here, this is the broadly syndicated CLO. So this is 90% of the CLO market. And so the AAA, we don't have it broken out here, but within the investment grade debt, 65% of that is going to be your AAA. And first loss equity here, so it's 10%, so 50 million of the 500 million of assets. So then if we're talking about middle market CLOs, they're less levered, so you have more equity. So equity might be 60 million. And then if you're an investor in like a AAA, for example, the attachment point is more like a 55% advance. And kind of like a key thing in terms of like the universe of securities that we're choosing is that the difference between 50 million of first loss equity and 60 million, which is the middle market CLO, I mean, that is what corresponds to the delta that you see in these lines. So the more equity you have in the CLO, the more credit support that provides for the double B, and the more defaults you can withstand. Yeah.
Can you talk about some of the nuances between the BSL CLO market and the middle market CLOs?
Sure. So in the broadly syndicated CLO market, you're going to find, the issuers that we talked about. So like the Assurions, the Cablevisions of the world. So these are companies that borrow $1 billion plus. They go to like a JP Morgan or a Bank of America that underwrites the loan and then trades it, or syndicates it amongst, 100 different buyers, and it trades around in the market. And if you're a large company, that's like your cheapest form of financing, and so it's very popular. If we're talking about middle market loan pools, basically it's companies with, call it 200 to 400 million of revenue. And so they provide a material product and service in the economy, but they're never going to be a household name. And so if you're an investor in middle market CLOs, you get a few things. One is that the loan documentation is written in a way that's more favorable to you as a lender. You also get a higher interest rate, which is beneficial for both the double B and the equity. And then you generally get just a slightly lower loan to value initially out of the gate. And so for all those reasons, we like the middle market CLOs for both equity and double B. But then on top of that, we're at FireRock focused on risk-adjusted returns. And so if you look in the middle market CLOs, you're going to find a loan pool that more mirrors like a Cliffwater Direct Lending Index, for example. And so you'll see a lot of stability in the underlying loans, and that means more stability in CLO equity pricing and double B pricing. And in contrast, if we're talking about a broadly syndicated or traded loan portfolio, you're going to see a lot of loans where guys are looking for liquidity and loans trade down and trade up. And so traded loans have more volatility. That volatility works its way into the double B and the equity. And so for us, like at FireRock, what we find is that if you can get better returns from middle market and you have less volatility along the way, that works for us. The other, and I'm kind of describing it as though there's no kind of downside to it, and I really think that's true. That kind of what has worked for us as an asset manager, where we're kind of slightly short of $1 billion in AUM, it's easy for us to kind of be fully invested in this kind of niche of the CLO space. For us, we find a lot of attractive opportunities. But if you're one of the larger investment managers in the space, our 10% niche, just isn't gonna work for you. You're not gonna be able to start a fund that has enough, that where you could grow it enough that would move the needle for you. And so we're big believers in the middle market CLOs. Sure.
Is there a way we can get this education slide deck?
Yeah, so you can just find it on the FireRock Global website, And I think the slides are there, and yeah, that's a good place to look. Great. Well, thanks a lot. Enjoyed being here.